Remember, dude, you're getting a Dell? Now I think is, dude, what the heck happened to the stock of Dell? Last Friday, the iconic PC maker with a huge enterprise business saw its stock lose nearly 18% of its value before sinking another 5% today, all because Dell reported a widely panned quarter on Thursday night. Whoa, was it ever? Keep in mind, though, going into earnings, this was one of the hottest stocks on the planet. From the end of 2022 through Thursday's close, this thing had given you a phenomenal 323% gain. The previous 2 quarters caused the stock to instantly roar higher. In short, it came in as hot as you could possibly have, and it was pretty much priced for perfection. Worse, the devastation in Dell doesn't really jive with everything else we've seen in tech. We know that enterprise software is becoming no man's land. We've established that, right? Because customers still need to figure out how much to spend on this stuff now that AI is changing the world. But that's also been a major opportunity for the hardware side, the Dell side. As businesses spend fortunes to build out their AI capabilities, Dell is a key NVIDIA partner, for heaven's sake. HP Inc. reported a great quarter that sent its stock into the stratosphere. So we need to figure out what went wrong with Dell, because the stock's post-earnings meltdown really does call a lot of things into question. It shattered a lot of people. Before we start jumping at the shadows, you need to understand that Dell's actual results, they were fine. The company delivered a clean revenue beat with better-than-expected sales for both infrastructure solutions, their servers and storage business, as well as their client solutions group, which is all about personal computers and peripherals. The real strength here is in the infrastructure solutions division. It was up 22% year-over-year, including servers and networking, up 42%. Now, the earnings lines weren't as clean as the revenue lines. Dell only posted a 2-cent earnings beat off a $1.25 per share basis, and both their operating income and net income came in a bit light, while their free cash flow was down 9% year-over-year. That was a little unfathomable. Management's guide, let's call it mixed. For the current quarter, Dell's revenue outlook was higher than expected, but its earnings outlook was a dud. For the full year, management raised their sales and earnings forecast, but warned of larger gross margin declines than previously expected, thanks to inflationary input costs and a higher mix of AI-optimized servers. Problem is, they didn't raise the earnings forecast enough. It really caught up to what Wall Street was already looking for. Ooh, boy, that's bad. So what went wrong here? The first issue is simple. The expectations just got too high. Just in 2024, this stock had already more than doubled, up to 122% for the year as of the close last Thursday night. And much of those gains came in the weeks leading up to earnings. Dell was just under 125 at the end of April, and it roared to 170 right before the quarter. It did look unsustainable. Meanwhile, as the stock rallied and rallied, the analysts raised their price targets to stay in the same ballpark as the stock itself. And then were basically forced to raise their estimates to justify themselves. When Dell raised their full-year forecast to a midpoint of 765 last Thursday, Wall Street considered that a merely in-line figure. But at the end of February, those same analysts only expected them to earn $7.16 for the full year. It's just that they spent the next few months aggressively bumping their numbers. By the way, Dell's still stuck on this great expectations treadmill. Over the last few days, the full-year earnings consensus has crept up to $7.74. And I'm just talking about the official sell-side analyst numbers. Dell also has to contend with what's known as the whisper number, the numbers that its bullish shareholders are really expecting. These aren't tracked anywhere, so there's no such thing as an official whisper number. But bullish hedge funds were looking for something a lot higher than even the analysts projected. To them, the full-year forecast was a flat-out disappointment. They were big sellers. So the main problem is that Dell failed to live up to irrationally high expectations. The expectations that fueled the stock's stunning rally this year. That's the main reason the stock got clubbed on Friday. But there's something else that went wrong, too, and this problem is more meaningful. Basically, with this quarter, investors came to realize that maybe Dell's AI business, the big growth opportunity here, might not be as profitable as we thought, at least not initially. Of course, the AI numbers that Dell reported were pretty strong. In fact, the sales momentum is incredible here. Management says that shipments of specialized AI servers more than doubled versus the previous quarter, and their AI server backlog increased by more than 30%, again, just versus the previous 3 months. Those numbers are insane. But it's not doing much to drive higher earnings, at least this moment. During the Q&A session, in a momentous time on that conference call, the very tough, very smart Tony Sacconaghi from Bernstein put it bluntly, and I'm going to quote this because it was so tough. You added $1.7 billion in AI servers and operating profit was flat. So does that suggest that operating margins for AI servers were effectively zero? And if that's the case, how do you square that circle, end quote? Oh, man. CFO Yvonne McGill explained that they are expect operating income on the enterprise side to improve over the course of the year. But for the moment, she indicated that the AI business is not as profitable as Dell expects it'll be in the future, ideally the not too distant future. Right now, the problem is that large enterprise customers are driving the orders, and they tend to get better deals than smaller, medium-sized customers, so it leaves less for Dell. Later in the call, management went on to say that there are other higher margin parts of the AI business, specifically networking and storage equipment, and especially services like fully managed solutions, where Dell will basically build your entire NVIDIA-based AI hardware stack for a fee. But those businesses will scale later on. For now, much of the AI business consists of selling AI-optimized servers to large customers that negotiate good deals for themselves. So it's not as profitable as Wall Street seems to have wanted. So that's what happened. Expectations got out of whack, and the market suddenly started applying a higher level of scrutiny to the profitability of Dell's AI business, not just the growth. Now that you know that, let me ask you, do you really think that Dell stock deserved to be down 22% over the past 2 days? I certainly don't. For some perspective, with this pullback, the stock's back to its lowest level since May 13th. It didn't even roll back entire weeks of gains. Dell's still up 73% for the year. I think it was a healthy pullback for a stock that had gotten overheated. Let me put it another way. Before the quarter, Dell was selling for almost 23 times this year's earnings forecast. Now the forecast is higher, and the stock's a lot lower. So it's trading at roughly 17 times this year's numbers. I want that stock. I want it for the portfolio. Bottom line, Dell just got substantially cheaper while the expectations are more in tune with reality. Meanwhile, I think the fundamental AI story is very much on track. It just might take a little longer to play out. So I'd be a buyer. Let's go to John in New York. John.
Hey, Jim, how are you? Thank you for taking my call.
Of course, John. What's up?
Tesla.
Regarding
Tesla,
yeah.
I know that there's a lot of volatility in the company, but also I'm concerned about the unpredictable behavior of Elon.
Right.
So, and again, I'm investing for the long term. What's drop it, buy more?
No. Look, I think that. Look, I'm not saying that at $562 billion, the thing's done. I think if Elon gets the contract that he deserves, by the way, because it's really etched in stone that he was supposed to get what he got, and if they can make the cars into more autonomous machines that go do things for you, like you say, hey, listen, go pick me up a pizza at the Pizza Vita, and it goes to Pizza Vita, and then the guy gets, and then the guy brings it into the car, and then it comes back to you. That is what I call autonomous driving. When that happens, well, maybe it's just worth holding Tesla at these prices for when it does. Let's go to Nick in Florida. Nick.
Booyah, Jimmy Chill. I want to first thank you. I want to thank you for your keen insights every day and for your thought-provoking angles that you create with your interviews.
Well, thank you, man. That's awful nice.
Yeah, I know you have to keep it fresh, and you have no problem. Every day is so interesting.
Well, you know what? If you talked to my wife, she would say, like, "What are you reading? What are you reading?" And I'm always like, "Well, I'm reading about, I don't know, Dell." And she's just like, why don't you just put it down? And the answer is you. It's because of you. I can't put it down because then when you call me about a stock, I won't know it. So let's go to work.
Well, two things have changed a lot since I've been watching this show. One is more transparency with the CEO selling, insider selling. And the market speed has changed. Sometimes with bad news, it's face-ripping market speed. And my question tonight is regarding the company Samsara, IoT. It has AI capabilities, a promising future. But how much is the stock affected with its recent insider selling by their CEO? Is it a buy, a sell, or is it a pause and buy?
You know, I do think that the selling was large for the CEO relative to the small size of the company. But that said, what really bothers me is that I am not an enterprise software guy right now. I don't like these stocks. They're too expensive. And my take is that Samsara is not a stock that you want to own. Period. End of story. All right. Now, Dell just got substantially cheaper while the expectations are more in tune with reality. So I say, dude, get yourself some Dell. They have much more money, including my exclusive off the tape with David Novak, a leader among people. Don't miss my chat on leadership and more with the man behind so many of our favorite foods, including Cool Ranch Doritos. Yes. And then what should you make of the market's meme stock action? I'm going to give you my take on Roaring Kitty as he continues to make the headlines. And of course, which, by the way, is like, hey, and it's like Cole Porter. We have a Cole Porter market with the SEC. Anything goes. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.